Hi, we are going to be doing an exam standard question, testing the areas of audit risk, risk identification, and substantive procedures for inventory. Audit risk is an important element of the syllabus and must be thoroughly understood by students. To answer this question well, you must attempt all sections and answer the actual questions asked. We will start by going straight to the requirements and look for what it is we are being asked to do, which in this case, A, is explain and state. We then look at the number of marks available, which we can see is 6, and calculate the amount of time we should be spending by multiplying the number of marks by 1.8, giving us a total of 11 minutes to complete this part of the question. In B, we are asked to identify, describe, and explain. We look at the number of marks available, which we can see is 10, and calculate the amount of time we should be spending by multiplying the number of marks by 1.8, giving us a total of 18 minutes to complete this part of the question. In C, we are asked to describe. We then look at the number of marks available, which we can see is 4, giving us a total of 7 minutes to complete this part of the question. So, the overall time we should be spending on this question is 36 minutes. We will start working on section A of our answer, which asks us to explain the components of audit risk and, for each component, state an example of a factor which could result in increased audit risk. What this section of the question is not about is giving a definition of audit risk, or how audit risk components fit together into the audit risk model, or which audit risk components the auditor had control over. All of this will gain no marks. There are 3 components of audit risk: inherent risk, control risk, and detection risk. Inherent risk is defined as the weakness of an assertion about a class of transaction, account balance, or disclosure to a misstatement that could be material, either individually or when added together with other misstatements before consideration of any related controls. Inherent risk is affected by the nature of an entity. A factor which could result in an increase in inherent risk would be changes in the industry a company operates in. Other examples could be operations subject to a high degree of regulation, going concern, liquidity issues, new products or services, new locations, new accounting standards, complex accounting measurements, events or transactions with significant accounting estimates, or pending litigation and contingent liabilities. Looking at control risk, this is defined in a similar way to inherent risk, with the difference being that any misstatements will not be prevented or detected and corrected by an entity's inherent controls. Examples of factors which could result in an increase in control risk are a lack of personnel with appropriate accounting and financial reporting skills, changes in key personnel, including departure of key management, deficiencies in internal control, especially those not addressed by management, changes in the information technology environment, and the installation of significant new IT systems related to financial reporting. Looking at detection risk, this is defined as the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a potentially material misstatement, either individually or when aggregated with other misstatements. Detection risk is affected by sampling and non-sampling risk. Factors which can result in an increase in detection risk include inadequate planning, inappropriate assignment of personnel to the engagement team, failure to apply professional skepticism, inadequate supervision and review of the audit work performed, incorrect sampling techniques performed, and incorrect sample sizes. This now completes section A of our answer. Moving on to answering section B of the question, we are asked, using the information provided, to identify and describe 5 audit risks, and, explain the auditor's response to each risk in planning the audit of Link & Co. So, the key learning points for this question section are: answer the question asked, 5 audit risks, and 5 auditor responses. The question asks us to consider audit risk, not the company's business risks. Identify 5 issues from the company scenario given, and then link each issue identified to the audit risk involved in auditing the company's financial statements. Do not give a response that management would adopt, rather than you as an auditor. We now draw up a table, setting out the audit risks and the audit response to each risk identified. For completeness, we have covered 10 audit risks. In your exam answer, you are asked to describe 5 audit risks. You will not gain any extra marks by describing more than 5 audit risks. The first audit risk we discuss is the plan to capitalise development expenditure. To be capitalised, it must meet all of the criteria under IAS 38, intangible assets. Here, there is a risk that some projects may not reach the final development stage. These should be expensed instead. As a result, intangible assets could be overstated, and this risk is further increased because of the loan covenant requirements to maintain a minimum level of assets. The auditor's response to this identified risk is that a breakdown of the development expenditure should be reviewed and tested in detail to ensure that only projects which meet the capitalization criteria are included as an intangible asset, with the balance being expensed. The next audit risk identified is that the inventory valuation method used by the company is standard costing. This method is acceptable under IAS 2, inventories, only if the standard cost is a close approximation of the actual cost. The company has not updated its standard costs since the product was first developed. Because of this, there is a risk that these standard costs could be out of date, resulting in over or undervalued inventory. The auditor's response is that the standard costs used for inventory valuation should be tested in detail and compared to actual cost. Any significant variations should then be discussed with management, ensuring that the valuation is appropriate. The next audit risk identified is that the work in progress balance at the year end is likely to be material. The audit risk is that because of the type of production process involved, the audit team may not have the necessary experience to properly assess the quantity and value of the work in progress, leading potentially to misstated work in progress. The auditor should consider possibly using an independent expert to value the work in progress, with consent from management and before the year-end count. The fourth audit risk is that over 1/3 of the company's warehouses belong to third parties. The risk is that the auditors will need sufficient and appropriate evidence to confirm the quantities of inventory held in these locations, in order to verify completeness and existence. The audit response is that additional procedures will be required to ensure inventory quantities have been confirmed for both third-party and company-owned locations. The fifth audit risk is that the company introduced a new accounting system during the year. This is a critical system for the company's accounts preparation, and if there were any errors that occurred during the changeover process, these could impact on final amounts in the trial balance. The audit response is that the new system will need to be documented in full, and testing should be performed over the transfer of data from the old system to the new system. We will briefly cover 5 more audit risks here, with a complete exam standard response at the end of this question section later, for your own revision. IT aspects of new accounting system. Significant finance raised during the year. $2 million of equity finance. $4.9 million of long-term loans. Loan covenants. Land and buildings revaluations at the year end. And reducing the reporting timetable for the company. For the IT aspects of the new accounting system, there are IT personnel and support risks, and financial error risks, which the auditor needs to address directly with the finance director, and ensure the audit team are also alert. Because there was significant finance raised during the year, the auditor needs to address the risks of ensuring funds were in fact received, and that proper disclosures were made. The new long-term loan has covenants attached to it that need to be properly disclosed in the financial statements, with the audit team maintaining its professional skepticism, particularly in relation to the risk of the company overstating its assets. For land and buildings that will be revalued at the year end, the revaluations involved could be significant, and the auditor needs to review and recalculate to ensure valuations are correct. Reducing the reporting timetable for the company, which is already quite short, may only be achievable by way of carrying out an interim audit. This completes section B. We now look at the last section of the question, section C, which asks us to describe the substantive procedures to be performed to obtain sufficient appropriate evidence in relation to inventory held at the third-party warehouses and the use of standard costs for inventory valuation. Dealing firstly with the inventory held at the third-party warehouses, the auditor should send a letter requesting direct confirmation of inventory balances held at the year end from the third-party warehouse providers regarding quantities and condition. The auditor should attend inventory counts, where performed, at third-party warehouses and review the controls in operation to ensure the completeness and existence of inventory. The auditor should inspect any reports produced by the auditors of the warehouse in relation to the adequacy of controls over inventory, and the auditor should inspect any documentation in respect to third-party inventory. In answering Part C, Section 2, the auditor should discuss with the management of the company the basis of the standard costs applied to the inventory valuation, and how often these standard costs are reviewed and updated. The auditor should review the level of variances between standard costs and actual costs, and discuss with management how these variances are treated. The auditor should obtain a breakdown of the company's standard costs, and agree a sample of these costs to actual invoices or wage records to assess their reasonableness. This completes this section. This also completes our answer for this question.